as we get ready to trade June week 2, 2022, and we're heading into the ES contract rollover Thursday night. We just saw a pretty big rally take place over the course of the last couple of weeks that took us all the way up to 4177.51 on Friday. I'm sorry, on Thursday, headed into the non-farm payrolls. Is that it? Is that the top of this particular swing as we head into contract expiration for ES, which affects how we trade the S&P 500, or do we have a little bit higher to go? Because on Friday, this really tight range that we got really looked to me like just a trapping in after consistent 100-point wide days most of the week. On Friday, we only traded a 40-point range, and it really looks like it was an effort to trap in, maybe short 41.50 and lower calls into this swing up on Thursday, and maybe shorting 4,100 puts into this low on Wednesday and Thursday that each day got down. One day got down to 40.73. That was our low for the week on Wednesday. And then Thursday, we held just above that at 40.74 while CNBC was interviewing Lael Brainerd, vice chair of the Fed. And then, boom, we took off after that interview and rallied over 100 points to 41.77 into the close. Certainly was a nice chance to short some 4,100 puts, and that's kind of reflected in where our low was on Friday, only getting down to 40.98 and closing above 4,100 at the end of the day. Our current closing low for the month of June was on Wednesday as well at 41.01. That's going to leave us a mark to watch. A close below 4,100 is a change in trend, and maybe will show us that we're ready to move further to the downside. Continuing to hold above a close above 4,100 is a bullish sign. So let's take all those facts and see where it gets us as the week goes on. I'm going to apologize in advance. My clock is going to go off in the background. Please just try to ignore it. When we look at our one of our daily charts of the S&P 500, the simplified one, the one that we kind of just try to concentrate on the simple moving averages, the forks, and the main breakout points and the lows. As I was talking about all week long, in the thread, we're looking at the top of the bear fork, and we are getting very close to a breakout of it. On Monday, it's going to finally fall below 4,200. It's only going to take an 11-point move above the high for the week we just traded to break out of the top of this bear fork. If we can break out of the top of the fork, we're going to move on to the 50-day. If we can break out over the 50-day, we're going for the median line of the bull fork that we're in, which rests right in here in line with this major breakout point of 43.10, which we've talked about in past videos. You can see where these highs kept coming up here and failing to get above 43.10 and where we've sold back off from. So that is a main breakout point along with the median line of our bull fork. If we are going to come in weak on Monday and break down below these lows that we set, make a new June low below 40.73, fill the gap to this close back at the end of May as we were headed into the Memorial Day holiday. If we break down below all that, we break down below the 10-day simple moving average and below the 20-day simple moving average, then we've definitely got ourselves the interim top for now. And we're going to work our way back down here into this huge cavern of space that lies between where our closing low is for the year and our intraday low, 3,900 versus 38.10. And look what runs right through that, the bottom of our bull fork. So as we fail to make a breakout of the top of our bear fork, maybe we're going to come down here to test the bottom of our bull fork. And that, to my mind, if we came down here, tested and held this and closed down here, that would really sew up this problem of this big space between the closing low and the intraday low and give us a much more tradable bottom for the market than what we have right now. So let's see how that works out. What's going to fuel us kind of depends on what's going on here with this 10, 20-day simple moving average bullish cross that's going on. Let's look at this in a little more close-up on our roadmap. This support that we saw last week, starting with the Friday going into Memorial Day weekend and continuing on through this 4-day week we just traded, this sideways support has helped the 20-day simple moving average flatten out and begin to rise. If we have one more day of holding above this range, this thing is going to turn and rise, and maybe that's going to give us the power to break out towards the top of our bear fork. And if that takes until Tuesday to happen, it's only going to take about 41.80 to break out. not even the 41.88 that we would see on Monday. If we come in weak and we just, bam, just break down below the 10-day, fill this gap on Monday, coming right in out of the gate, then it's over. What they're trying to do is to counteract this buy signal and fend it off. So this is really, kind of like the game of chicken that's happening here right now. Either this is going to be allowed to continue to pull through and it's going to fuel us higher, or they're going to go after this and break down below it and go after this big space here between the closing low and the intraday low. All right, let's take a look at something else here. Let's take a look at Apple. Apple really was the motivation for the gap down open on Friday, not the non-farm payrolls. There was a negative note in the pre-market from Katie Huberty, long-standing, well-known analyst of Apple. And she put out a negative note after Apple had just spent the last several days, and here it was on Thursday, along with the S&P 500, moving up to a high here in the face of a death cross that's trying to take place over its head here, with the 50-day getting ready to cross down through the 200-day simple moving average. However, the 200-day is still a rising line, and so it's really not a death cross until this 200 line rolls over. And here we were, had that note not come out, it's a good chance we would have continued the rally on Friday. Although, maybe not, because there were those option bets in place that I explained on the first chart when we started the video. But had it been allowed to continue on Friday, it was going to be going after this pair of simple moving averages to try and unwind this cross. We have the WWDC coming up this week with Apple, and right now on Friday, in the face of that note, which should have been a really, really, really negative event for the stock, it still held around 145. A little dip below it, but closed above 145. That's a really important mark. 150 is also a really important mark for the stock. It's got to get back here and close above 150 for a few days in a row. It pulled off one cross here on Thursday above it. Need to see about 2, 3, 4 closes in a row above 150, and then we're back in business on Apple. The S&P 500 can't succeed without Apple. So this is a really great indicator in the side view mirror. Apple holding 145 and getting back for a close above 150. One other thing I want to talk about before we end this video is the option volume on the S&P 500. And I'm trying to move my option chart here, but it's not. Oh, there. Whoop. Oh, come on, think or swim. Well, let's start with looking at Friday. Next Friday expiration, volume leaders were the 4,000 and the 4,200s. 4,200 calls, 4,000 puts. 7,000 of one, almost 7,000 of the other. We are watching for which side of this trade falls below the $11 window. They both went out around $14, $15 on Friday. One side or the other is going to fail to hold its $11 window, and that's going to give you the signal as to which side of the trade you should be on. You want to be on the side of the trade that's holding its $11 window, not on the side of the trade that's losing its $11 window. In fact, when we look at Monday's expiration options, if it lets me roll here, I'm not suggesting that we use these. This is a little far out of the money, and maybe these are just lottery tickets or accumulated volume over the course of the day on Friday, but over 10,000 of the same strikes traded on the puts, and almost 10,000 on the calls, around $1 on each side, and we'll see if this ends up giving us a good clue about which way we're going to go come next week. So 4,200 rhymes a lot with breaking out of that bear fork. 4,000 rhymes a lot with breaking down below the 10 and the 20-day simple moving average. So we'll see which side of the trade wins, but just pointing out about this stuff on the Monday expiration, what we really want to watch here is which side of this trade here is going to hold the $11 window. Okay, that's it. I hope this video helps you out and you have a great rest of your Sunday. As always, good luck and good trading.